Oh boy, it looks like it's just two of us so far. Well, let's see. I hope everyone else got the invitations. Yeah, we're expecting 8 people, I believe. So, all right, you know what? Let me just get stuff open here. So we'll be looking at this first session here. We're introducing the topic of derivative securities. We'll be looking at a broad overview of the basic types of derivatives. And as we go along, of course, we can focus on each one individually and gain more in-depth understanding of how each one works. Particularly what we want to know is how are these contracts structured and how are they priced and how can they be used for hedging purposes. In some cases, we'll also think about how they can be used for speculation, but mainly these derivatives were designed for hedging purposes. But of course, we know that sometimes they can be used for gambling or speculation. And in fact, throughout the last several decades, there have been several catastrophic losses suffered by different financial institutions who were using derivatives in a way that was, let's just say, not appropriate. In fact, you could actually have a whole separate course on derivatives disasters. And so we may mention a few of these as we go along, but you'll see why as we progress through the material, why it would be possible to lose a lot of money with derivatives if you don't really know what you're doing, or else if they're being used inappropriately. So we'll start with the 4 basic types. And, of course, we'll later on be looking at more complicated variations of these. We're starting with forwards and futures because they're more straightforward than the others, and they've been around longest. In fact, forward contracts have probably been traded for many, many centuries. Futures contracts are a little bit newer, but we know that they definitely have been around since at least the 19th century and probably soon earlier than that. The last 2 are the ones that really are relatively new. Swaps have realistically only been around since the early 80s. And we'll talk about their interesting history later on. And options, although they've existed for probably centuries, the options that we're trading today in the marketplace have only realistically been traded in the U.S. since the early 70s. And that was because they were just so complicated that people really didn't understand them very well. And so it had to wait until the first option pricing model was developed before realistically they could be traded properly. Because, imagine yourself trying to trade something that you have no idea what it's worth. It wasn't very successful. But then around the same time as the first option pricing model came along, options started trading on the Chicago Board Options Exchange in the US. And since then, the volume of trading has, let's just say, exploded. The volume of outstanding options is just astronomical. But anyway, so we'll start out in the beginning with the 4 basic types. And of course, we want to understand what they're used for. So we'll talk mainly about hedging strategies. But we also, of course, want to consider the idea of speculation. Realistically, if you're interested mainly in speculation, probably you'll end up using options because they're so heavily leveraged. Their properties make them very useful for speculation. These others would be a little bit more difficult to speculate with, but it's not impossible. But people are basically trading these to make profits. Most likely they'd be using options. So, and again, it's because of the leveraging. The idea behind options is that if you buy options, the upside potential, the profit potential is literally unlimited, whereas the downside potential is restricted to a loss of your investment, 100% of your investment. If you sell options, on the other hand, you can lose many, many times what you started out with. And in fact, this is one of the ways in which many of these derivative disasters have gotten started by taking, let's say, not the best positions in different markets with options. And in fact, Barings Bank, as we'll see later on, was brought down by a trader in Singapore who was betting that the Japanese Nikkei 225 would make a huge comeback, and it never did. So he lost over $1 billion in a matter of months. So it doesn't make you think about how risky these things really are, or they can be. In fact, you may have heard this great quote from Warren Buffett He once referred to derivatives as weapons of financial mass destruction because so many people have lost so much money with them. And he also said he would never buy any of these because he just doesn't understand them. But if they're used well or used correctly, they can be tremendously efficient hedging tools. And so this is one of the reasons why we keep seeing them used, because they are so useful for that purpose. All right, well, anyway, hedging, of course, means reducing the risk of a portfolio of assets. And speculation means essentially gambling. You're taking a position on an asset with an eye towards making profits down the road. So what's good about derivatives too is that they make it possible to set up positions that would be impossible to create with other types of securities. And we'll see what that means as we go along. But in other words, they give us more flexibility as far as the positions that we can create. And in fact, especially with the options, they can be combined with each other in ways that create trading strategies that would be impossible with any other existing securities. And we will spend quite a bit of time looking at different trading strategies with options. And what's interesting about them is that it's insane what kinds of combinations of positions can be created with these things. For example, you could set up a position where you profit from the dollar appreciating against the pound, but only under certain conditions. It just, whatever you want to do, it's basically possible to set up. Sometimes I compare these to like financial Legos, because in fact, you can create anything you want with them. All right, so yeah, I mentioned earlier the Barings Bank, and we will mention some of these derivatives disasters as we go along. You may not have heard about this case. Barings Bank was this old line British bank that had been around since at least the 18th century. In fact, interestingly enough, Barings Bank is the one that lent the United States the money that it needed to make the Louisiana Purchase. So they'd been around for a long time. And one year they suddenly decided that it was time to have a trading unit in Singapore because they didn't have any coverage out there. And so they sent this one trader named Nicholas Leeson to start up this trading operation. The mistake they made was that they put him in charge of both the front and the back office, which meant that he was not only making the trades, but he was also reporting the results back to London. And of course, he didn't know what he was doing. He took a lot of very big risks with derivatives. And so it wasn't long before he had lost about $1 billion worth of the bank's capital. And they were essentially wiped out. And in fact, they were sold to ING for a pound, because that's how much money they'd lost. And now, interestingly enough, Nick Leeson, unlike many of the others, actually did jail time because there was fraud involved in this one. It wasn't just his incompetence. He defrauded the London office into thinking that things were going on that weren't. So he did actually spend some time in jail in Germany. But anyway, he was betting on the Nikkei 225, which is essentially the equivalent of the Japanese S&P 500. He was betting on it going up significantly. And unfortunately for him, that was the time of the Kobe earthquake. And so obviously the Nikkei went down quite a bit. And because he was so heavily leveraged with all these contracts, he lost a lot of money in a very big hurry. All right. Well, anyway, and by the way, this one was actually turned into a book and a movie, which is kind of unusual. You don't often see movies made out of bad trading, but this one it was called Rogue Trader. And they really, in my opinion, did a very good job of explaining what happened. A lot of times these movies that are about real world events, sometimes they do a good job explaining the details. Sometimes they don't. But another one that I think did a very good job was, if you've ever seen that movie, The Big Short, about the subprime crisis in the late 2000s, they really did an excellent job of explaining what was happening with all the credit derivatives that were floating around. And so sometimes it happens. Sometimes a movie can be successful and accurate too. But anyway, so we'll start out just by introducing the whole concept of derivative securities. And before we forget, I almost forgot. Before we get too far into this, I wanted to open up the syllabus for a second. Just I know I sent you a copy of this, but I just wanted to go over a couple of details and then we can get back to this. First of all, of course, we'll have 8 sessions at the same time every week. They'll all be online. Now, I'm still not that familiar with Brightspace. They just introduced fairly quickly, recently rather. The thing that I'm concerned about is I'm not so sure how it works with the videos. If it has the capability of storing the videos for this class. I'm looking into that, but if the videos are too big for Brightspace, I can just put them on my YouTube account. And in fact, I have been doing that regularly during the COVID. When the COVID was in full swing, I guess, all my classes were online. And what I was doing was recording them all, and then I would put them in my YouTube account. And apparently nobody had any difficulty finding them. So what I might just do is put them in both places, in Brightspace and in my YouTube account, just to be on the safe side. So what you would do is you would go into YouTube and you would find my name. And now what would happen is I will be creating what's called a playlist where I can store just the videos for this class, because I have many other classes going on, as you can see. And so in order to make it easier for you to find our materials, after tonight, I'll create a playlist with the first video tonight. And that will have our name on it, Derivatives Spring 2022. So if you want to look there for the videos, you can find them there, or possibly in Brightspace. Like I said, I'm still looking into that. But either way, I'll let you know where the videos are found, just in case you feel like you want to watch the videos. You never know. Like, especially if you're not here, of course, one week, then you can watch the videos. Or if you are here, you may want to go back and review some of the material, and that's great. And while you're at it, you might want to take a look at my other stuff here. See, oh, there it is. That was the class from last fall, so it's still there. So I did manage to get it in there. And, YouTube has a lot of storage capabilities. I've never run into any storage limits there. So, so I've got all kinds of fun stuff here. But for us, it'll just say Derivatives Spring 2022. All right. So what else do we need to know? As far as this, there is a book for this class. I'm following this book called Options, Futures, and Other Derivative Securities by John Hull. It's a classic in the field. Okay, if you are interested in derivatives, you must own a copy of this book. It is like the gold standard, let's say, for derivatives textbooks. The first edition came out maybe 20 years ago, and he sold 1 million copies of this thing because it's so useful. He covers everything. It's an amazing book. And so the notes that I've written for this class were, based on his approach. And what's great about this book too is that you can use it as background for studying for certain types of standardized exams. For example, there are parts of the CFA exam that require you to know about derivative securities. There's also some risk management exams that you can take that are based on this, like for example, the FRM. If you've heard of it, I actually have an FRM. It stands for Financial Risk Manager. And it requires you to know a significant amount about the topics we're doing in this class, but also a lot of other areas, because derivatives are very widely used in the risk management industry to help reduce risk. And so it's important to understand what they are and how they work. So that's the book. I strongly, strongly recommend that you own your own copy of it, especially if you're studying more or taking more courses in this area. It's just one of those reference books that everyone should have a copy of it. And also, we're going to use a lot of Excel in this class. Now, I assume that everyone here uses Excel. It doesn't really matter if you do or you don't. I'll show you everything you need to know. A lot of what we'll be doing will be just easier to implement it in Excel than trying to use, let's say, a calculator or some kind of a software like, MATLAB or something like that, which you certainly could do. But I think for an introductory course like this, we're better off just sticking with Excel. It can do everything we need. And of course, everybody should be very familiar with it. So a lot of results will be done. And in fact, just about all the assignments that we'll have in this class are meant to be done in Excel anyway. In fact, while we're talking about assignments, let me just show you the one that's I included when I sent out your materials last night. What happened here? Here it is. So yes, you're going to do some basic calculations. Well, actually, now that I look at this, you probably don't have to use Excel for this one. But down the road, pretty much all the assignments will probably be better off done in Excel rather than trying to do it with paper and a calculator, although you certainly can feel free to do that too. And these are all based on what we'll be doing tonight. And so the slides, of course, I've sent you a copy last night. And so you'll have all this information right in front of you. What else do you need to know? Well, we have the outline here. We have all the topics are listed. Yes, we have all of this NYU language. Here it is. These are the topics that we're going to cover. And you can see we're going to do quite a few topics from Hull's book. And the grading is based on the assignments for the most part. There's no exams as such. Just every week we'll have an assignment, they'll send it in to me, and that will take care of the grade. All right, so it doesn't make sense to try to have exams in an 8-week class like this. So instead, you'll get your hands on these wonderful Excel examples, and that's how you'll learn the material. All right, what else? I think that's all we need to see from this syllabus. There's all kinds of, it's like a legal document. There's all kinds of stuff in here, but the key details are basically the Hull's book, the Excel, and the topics that we're going to cover. And the recordings, yes, just you need to know where they're located. So like I am going to try to get stuff into Brightspace too. It's just that I haven't really had time to set it up properly, but I'm working on that. I hope to have everything set up by next week when we meet again. And I'll know at that time if there's enough room in there for our videos or not. And like I said, if not, you'll be able to just go find them in YouTube. Okay. All right. Oh, you know what oh my God, I have to make a change to the syllabus. I just realized it still talks about NYU classes. That should say Brightspace because we literally just changed over. All right, that's enough of that. Let's get back to the good stuff. The derivatives. Now, just in general, a derivative is a financial asset whose value is derived. That's the magic word right there, derived from an underlying security. Could be a stock, it could be a bond, it could be the price of a commodity like gold or silver or oil. They also can be based on just economic variables like interest rates or stock indexes like the S&P 500. And believe it or not, at this point in time, derivatives are available on completely non-financial outcomes like snowfall or temperatures. Now, those are clearly meant for very specialized applications. The thing about derivatives is that some of them trade very heavily and some of them are really just meant for specific circumstances, and they really need to be designed by an investment bank or somebody like that. In other words, if I need something really bizarre for my special circumstances, I'm not going to find it trading in the marketplace. I might approach a Goldman Sachs or Morgan Stanley and say, could you please design this security just for me? And they'll go ahead and do it. And they'll tell me how much it costs. And then this is how we wind up with derivatives on snowfall and even like catastrophes like earthquakes. You can do this. In fact, there's almost nothing that really can't be set up as the basis for a derivative. But some of them, like certain ones are trading regularly in the marketplace through exchanges. And some of them are just being essentially customized for the needs of the individual hedger. So some of them are available through exchanges. Now, the exchanges that do trade in derivatives tend to specialize in them. The one that I would say is probably the most active in the United States is the Chicago Mercantile Exchange. if you go there, you can see all the many products that they trade on a regular basis. And now what's good, by the way, here's a helpful hint. If you want more information about the derivatives markets, often one of the best places to find it is at the websites of these exchanges, because they want you to do business with them. And one way they can encourage you to do that is to give you all this wonderful education. They have all these resources that you can download for free and learn more about their products. And in fact, they even have, like you can see here, research that you can read and understand what's going on in the markets. And, all kinds of interesting things are here, just waiting for you to download them. And again, the motivation is the more they teach you about how these products work, the more likely you are to want to do business with them. And so that's what this part is all about. So just don't overlook this if you're interested in learning more about these securities that we're going to be looking at. And look at this, academic resources. I think they even have online videos and courses and all kinds of wonderful stuff. But anyway, I think you can buy data from them, but we're not going to do that, of course. But here's a list of the things they trade. So let's say you're interested in foreign exchange derivatives. And then they'll come back and say, well, all right, here's what we've got. And let's say I'm interested in trading currency options. And then here's a list of the ones that are currently out there in the marketplace. And you can see, for example, this is the Euro US dollar monthly option. This is an option that's written on the exchange rate between the euro and the dollar. And you can see they've got one for Australia and Canada and Japan. All the major currency pairs are listed here. And, if you're interested in one, you can just go ahead and buy it. And they'll give you all the details. Here we go. Yes, you can ask questions. Yes, absolutely. I'm glad you mentioned that. I completely forgot about it. That's one detail that I forgot to mention. Sure, if you want to ask a question, I don't know if your microphones are muted or not. You can always unmute them and just fire away. Because otherwise I won't realize that you're asking a question. The thing is about this chat button is that it's not that noticeable. You know what I mean? Like I don't know how long your message has been sitting there, but I just noticed it. In the past, I don't know what they did. They used to have it set up so it would flash orange when there's a question. And now it doesn't seem to do that anymore. So if you want to ask, go right ahead. Sorry. Yeah, and because otherwise it's hard for me to notice it up there. But anyway, yeah, go ahead.
I just wanted to ask, this Chicago Mercantile, this website, this is like the stock market for derivatives?
It is exactly that's a perfect analogy. So in other words, if I want a derivative, I can't go to the New York Stock Exchange. They don't carry them. I want to come here though. This is one of the busiest derivatives exchanges in the country, in the world, really. It's not the only one, but it's one of the bigger ones. And so if you need something, they probably have it. Now, if they don't have what you want, that's when you have to approach a financial institution that specializes in this kind of thing. And you can say, listen, I need this particular security that it doesn't exist already. Could you design one for me? And they will do it. They'll put it together. They have a team of what they call financial engineers, and they will literally create a security for you, which when you come right down to it, a security really is just a contract. Okay, you're just entering into a contract with your financial institution, and the contract specifies what cash flows you are looking to acquire, and under what circumstances you will make a profit, and what will cause you to make a loss, and then they will figure out how much to charge you for it. And it's a very lucrative business. In fact, interestingly enough, I was told by people who do this that for any team that designs derivative securities, at least 50% of the members are usually lawyers, because like I said, it's really just a contract. And they have to cover every possible contingency to make sure that they don't end up losing tons of money. if something goes horribly wrong. But with an exchange, you just look at the list and say, I want this or I want that, and you buy it from them. And as we'll see later on, one of the nice things about an exchange is that if you get into one of these contracts and something goes wrong, they will guarantee the performance of these contracts. So you don't have to worry about credit risk. If I go to a financial institution, though, it's not impossible that they could go bankrupt while my contract is in effect. So there's some credit risk associated with going to a financial institution that you're not going to get here. But the financial institution can give you, they can customize the security for you, whereas here you're just taking whatever's available. Interestingly enough, sometimes you find exchanges that do have some derivatives, but not tons of them. The Philadelphia Stock Exchange, for example, actually does have currency options. And in fact, what they offer, which is very helpful, is many of these options require you to make very large purchases. For example, the contract on the British pound requires you to take a position in 62,500 pounds. That's a big exposure. On the Philadelphia Stock Exchange, they could give you a contract for as little as 10,000 pounds. So they have smaller contracts that are available for investors who need them. And there's plenty more. And then of course we have them in London has the London International Financial Futures Exchange, or LIFE. There it is. So they have their own, of course. And so throughout the world, there are many derivatives exchanges, and this is what they do. This is what they specialize in. Okay, but like I said, if you need one that's customized, we deal directly with the financial institution, and we are then considered to be counterparties to that contract. So I mentioned a few of these, Chicago Mercantile Exchange, New York Mercantile Exchange, which mainly deals with energy derivatives. And then the one I just showed you, the London International Financial Futures Exchange, or LIFE. When we go directly to a counterparty, we are dealing in what's said to be the over-the-counter market. And in fact, interestingly enough, even some stocks trade in the over-the-counter market. In other words, it's just a market where securities are directly traded between counterparties. Now, the good thing about this is that there's a lot of customization available, but the bad thing is there's also a lot of credit risk. You're not going to get any credit risk with the exchange. They can guarantee that everything you buy from them, the contract will be honored. Now, we mentioned earlier that the four basic types are the forward contracts, the futures contracts, swaps, and options. And they all have their purposes. They all have their, under some conditions, each one of these is very valuable. Otherwise, one of them would disappear if they weren't all extremely valuable under different conditions. So for certain types of exposures, your best bet is to hedge it with a forward contract. For some cases, a futures contract might be a better choice. Swaps are good for hedging repeated exposures. And options, well, they're the most flexible of them all, but they're also relatively expensive. So they all have their advantages and disadvantages. So let's start with the forward contract. This is a very simple idea, and these have been around for a very long time. It's basically a contract. It's an agreement where we can agree to buy or sell an asset at a particular time in the future. But the key detail here is that the price is settled on today. Okay, in other words, I could enter into a contract, for example, in which I agree to buy gold in 6 months, and the contract will specify the price that I will pay in 6 months. Okay, not whatever the price is at the time. I'm locking in a price at, let's say that the price is $1,500. I'm entering into a contract which says, I promise to buy gold in 6 months, and you promise to sell it to me for $1,500. That's a forward contract. And you can see, now this is by the way, this is an over-the-counter product. This is negotiated directly between counterparties. So all the terms and conditions are negotiated between the counterparties. You can literally make it say anything you want. The advantage of that is that you might need something that's not trading actively in the marketplace. Like, suppose you're a metals dealer and you need to take a position in, let's say, zinc. I'll just randomly pick zinc. Well, zinc is not a very widely traded metal, but if you're in the business of producing something that uses zinc, it might be important to you to be able to lock in the price at which you can obtain your supplies of zinc. And so for that, you would need to go to the over-the-counter market and negotiate a contract with a counterparty, probably a financial institution. Or what if the time frame is very unusual? Let's say you need to acquire something, but not for, let's say, 18 months. Most of the products that trade over the exchanges have very short lifetimes, usually just a matter of a few months. If you need something different, you'll have to find it in the over-the-counter market. So these are very, very flexible, and you can customize it to literally anything you need. And the only issue here, like I said before, is that there's some potential for credit risk because you might be doing business with a financial institution that's on shaky ground. Like imagine if you entered into this contract with Lehman Brothers before the credit crisis, you'd be out of luck because they went out of business. But other than that, this is a very, very popular security. In fact, in the currency markets, as we'll see later on in that chapter, something like $5 to $6 trillion worth of currencies are traded every single day, of which about a third of it comes in the form of forward contracts. In other words, companies that do business overseas often enter into these contracts to reduce or eliminate their foreign exchange risk. You can lock in the price at which you can buy pounds in 6 months, for example, or the price at which you can sell Australian dollars. That's what these are very widely used for. Currency forwards are among the most commonly used forward contracts because obviously as more and more trade takes place, well, that means there's more and more exposure to foreign exchange risk throughout the world. And so there needs to be something available that lets us reduce or eliminate that risk. And this is one of the more popular ways of doing that. So that kind of tells you something when you're talking about $2 trillion a day worth of forward contracts just in the currency markets alone. What about all the other ones? Yeah. And in fact, another one of the more popular ones is forward contracts written on interest rates, which have a special name. Those are referred to at, let me just mention this as an aside, besides the currency forwards, I'll just toss this out there. Forward contracts written on currencies are among the most widely used types of forward contracts. But another very popular one is written on interest rates. These are known as forward rate agreements or FRAs. Okay, because you can imagine that interest rate risk is something that every company faces eventually, because we don't know what the cost of borrowing will be in the future. We don't know how much we can earn from our investments. So this is another enormous market here, the contracts that let us lock in the rate of interest at which we can borrow or lend in the future. It's just an agreement, but it means if we know that we'll have to borrow in 6 months, we may want to enter into this contract so that we can lock in the rate that we can borrow from our financial institution or lend, as the case may be. So because these are two of the biggest risks facing any business, foreign exchange risk and interest rate risk, that accounts for the huge popularity of these contracts. Now, we'll see more about these in a later chapter. Right now, of course, we're just looking at a broad overview of these contracts. We will definitely get to these sooner or later. and look at them in more detail, we will try to understand how their cash flows are determined, how they are priced, and how they can be used to hedge our risk. Now, here's an example of a foreign exchange forward contract. Imagine that before the COVID, at least, and before Brexit for that matter, this would have been a typical exchange rate between the dollar and the pound. Not so much anymore. Let's say that the exchange rate is $1.69.8. You look in the Wall Street Journal and you see this exchange rate. This number that you're seeing here is the price that I will pay to buy British pounds today. Sometimes that is known as the spot exchange rate. Okay, so the word spot here, spot exchange rate, is the price of a currency for immediate delivery. So most of the time, this is what you're dealing with. But if I want to enter into a 6-month forward contract, let's say I decided, or I'm in a position where in 6 months, I know that I will need to buy British pounds for my business. And I'm worried that the price will go up. Of course I am. I can lock in the price at 167.15 today. And so that in 6 months, I don't have to worry about any exchange rate risk because I already know how much they're going to cost me. It's kind of like almost like an insurance policy, I guess. But the good thing about this is that if the price goes up, well, it doesn't matter. I'm going to be paying 167.15 regardless. But here's the drawback. If the price goes down, I cannot save any money because I'm locked into paying 167.15 for those pounds, no matter what. So it's a good thing, but it can have potential problems too. But you can see why it's so helpful to have this type of contract, because we can just get rid of all of our foreign exchange risk with a position like this. Now, oh, by the way, you've all experienced this. You go to a foreign country and you need to buy some currencies. Before you get on the plane, and you're like, oh my God, maybe I should have some of that foreign currency in my pocket. Well, you go up to the window at JFK or whatever, and you notice that the exchange rates are quoted with 2 prices. There's a lower and an upper price, and the lower price is called the bid price, and the upper price is called the ask price. If I need to buy British pounds, I'm going to pay the $1.42. If I'm going to sell British pounds, I will receive the $1.32. In other words, I'm always at a disadvantage. The dealer always gets the good side of these deals. They charge you the highest price and they pay you the lowest price. The spread between the two is called the bid-ask spread. And this is the source of their profits. This is where their money comes from. They're making all these transactions, and each time they're making a small profit, so that by the end of the day, it does pile up, okay? And the size of the transaction is what ultimately determines the size of this bid-ask spread. In other words, if you're buying a few hundred pounds, the bid-ask spread could be very high. But if you're buying 1,000,000 pounds, well, then the bid-ask spread would be a lot smaller because they can afford to give you a better price because you're buying 1,000,000 pounds. So you've done this. You've all done this. Okay, so yes, the bid-ask spread for $1,000,000 transaction, look how tiny that is. That's like less than a penny. Because it's such a large transaction, even that bid-ask spread, when multiplied by $1,000,000, that's still a $2,000 profit from one trade. So that's why they're so happy to do this for you. So in fact, if you look at foreign exchange quotes in the internet, you'll see a single number there, typically. Like for example, the Bloomberg currency page. Let's say I want to know what's going on right now. So the dollar pound right now is $1.31.2 per pound. They've only got the one number listed there. What's actually happened is that they have averaged out the bid and the ask spread for a very large transaction. In the Wall Street Journal, that would be a $3 million transaction. So this is the average price between the bid and the ask prices for large transactions. You and I may not be able to conduct business at this price. And so, yeah, you've got all these interesting currency pairs here. And so we'll get back to this later on. But forward contracts, as we said, are traded in the over-the-counter market. These are not traded on exchanges, and they can therefore be customized. Okay, that's the beauty of them. Now, there's always going to be a lot of terminology in any new type of markets that you're looking at. The contract that lets you buy an asset, or if you have a position which gives you the right to buy, you're said to have a long forward position. Which means that if you're in a position to sell, if your contract gives you the obligation to sell, you're said to have a short forward position. So just remember, the word long means that I'm going to buy something, and the word short means that I'm going to sell something. And this is true across the board in the derivatives markets. All right, now what about hedging? Now we know that hedging is really what these were intended for. Not that you can't speculate with them, but mainly this is what they were designed to do. So, oh, by the way, just as a quick review, in case it's been a while since you thought about currencies, appreciation versus depreciation. You know that potentially every minute of every day, the foreign exchange markets are actually quite volatile, partially because so many currencies are being traded every day. So the values of each currency trade pretty regularly throughout the day. And unlike many other markets, the foreign exchange markets are open 24/7. Why is that? Well, because it's such an active market. And also, let's face it, I mean, no matter what time of the day it is, one of the exchanges will be open because it will be daylight in that time zone. So the major three regions are New York, London, and Tokyo. Between all three of those, I think there's 1 hour, sometime in the middle of the night, where all three of them are closed. And that's basically it. And during the weekend, there's so much demand for trading that it just never really stops. But sometimes a currency strengthens, and the official or the formal terminology for strengthening currency is that it is appreciating. And if it is getting weaker, it is said to be depreciating, or it is experiencing a depreciation. So let's say you look in the Wall Street Journal 2 days in a row. One day, the exchange rate is $1.30 per pound. The next day, it goes up to $1.35 a pound. The question is, which currency just appreciated and which one depreciated? Well, here's how you want to look at it. It takes more dollars to buy a pound now, which means that the dollar has weakened against the pound. So therefore, we say the dollar has depreciated against the pound, which implies that the pound must have appreciated against the dollar. Okay, that's important because it helps us understand our hedging strategies. All right, now imagine you're a U.S. importer. You're committed to spending 100 or buying 100,000 British pounds because we're buying British goods. You cannot pay for British goods with dollars. You must ultimately convert your dollars into pounds because the importer doesn't want your dollars. He wants your pounds. And we've already signed a contract. We're going to buy these 100,000 pounds worth of goods in 6 months. What is the thing that we worry about? Well, we worry about exactly what we're seeing here. Because at $1.30 a pound, this is going to cost us $130,000. But if that rises to $1.35, as you can see here, that's going to increase the cost to $135,000, which doesn't seem like a lot, but that might be the difference between making money and losing money. So we don't want that. We want to lock in the price that we are guaranteed that we will pay for our pounds in 6 months. So, but of course, the possibility always exists that the opposite will happen. The costs will drop and we'll save a little money. But, we're worried about it. We don't want to take on that risk. Our business is not foreign exchange. Our business is selling foreign products to American consumers. So rather than waiting 6 months and hoping for the best, what else could we do instead? Well, suppose that we have the opportunity to enter into a 6-month forward contract to lock in the price of these pounds at $1.32 per pound. No matter what happens to exchange rates in the meantime, in 6 months, those pounds will cost us $132,000. It's locked in. Now, that means net of the contract. Notice we'll pay the market price, but then the contract will provide us with a payoff that will reduce the cost to $1.32. Here's another one. If the forward exchange rate is $1.70 and we need to buy 100,000 pounds in 6 months, we've locked in a price at $170,000. This time I've got a diagram so you can see if we hedge our position, the horizontal line, 170,000 is the cost regardless of the spot exchange rate in 6 months. It's just the same. That's what it means to hedge. There's no more risk. If we wait and don't hedge and the exchange rate goes up, well, we saved ourselves a lot of money by hedging. But of course, if it goes down, we gave up the opportunity to save money. So we don't know what will happen, and this is why we might like to hedge. It's up to every individual company to decide if they want to hedge or not. It's not obviously necessary, but it really can help reduce the volatility of our cash flows, which is a huge deal, of course. You know, from one year to the next, we don't like our earnings to fluctuate too much if we can help it. And this is one way we can prevent that. All right. It's not good for our stock price. Let's put it that way if our earnings bounce around from one year to the next. All right. Now, if we're worried about the price going down, then we would take a short position. Here we're taking a long position because we're going to buy pounds in the future. Okay. If we need to sell pounds for some reason, we can take a short position instead of a long position. All right. So just as a quick reminder, so if you're worried about the price going up because we're buying, we enter into a long forward contract to offset our risk. If we are selling and we're worried about the risk of the price going down, then we can hedge that risk by entering into a short forward contract. Okay, so notice the contract locks in the price at which we can take our transaction in the future. Now, if you look on the Chicago Mercantile Exchange website, you'll see sitting there somewhere, let me just go get that one back. We're going to look at their futures page. Oh my God, look at this. By the way, I don't know if you knew it, but you can now buy derivatives on cryptocurrencies. Yeah, that really makes things more interesting because now you can speculate on the future direction of Bitcoin without actually owning it by buying a derivative security written on Bitcoin. And so I'm guessing that that's going to be a very popular contract. But let's see. Let's look for, oh, here we go. What are we doing here? This is trending pages. I don't know what that is. Oh, here we go. So what you're seeing here are what are called futures contracts. Now, a futures contract in a lot of ways is very similar to a forward contract. They are both designed to help us eliminate risk. And they both let us lock in a price, which we can buy or sell something in the future. But there are several important differences. And, you know, which one we use depends on our particular circumstances. And, oh, wow, look at that. They're still changing. You know, it's only 5:50 in Chicago. I don't know what time this place closes. But see, they've added some of the other ones too, like some of these emerging markets currencies. So if I have a position in Mexico, well, guess what? I can hedge my risk with a Mexican peso future or Brazilian real or South African rand. There's so many of them. Look at that. And these, which by the way, Anytime we have an exchange rate that does not involve the dollar, it's called a cross exchange rate. Let me, just in case we run into that again, let me just throw that in here. An exchange rate that does not include the US dollar is known as a cross exchange rate. So if we go back to the Bloomberg page, they had a few of them here. For example, the euro yen right here, 134.7. That actually refers to the number of yen that you would require to buy 1 euro. 134.7 is a cross exchange rate because it doesn't specifically mention the dollar. Okay. So those are cross exchange rates. And although I just want to mention that even though the dollar is not mentioned there, these rates are derived from the, would have been derived from the yen dollar exchange rate and the euro dollar exchange rate. Okay, so there's the dollars just canceled each other out. That's why it's not there. But all transactions in the currency markets ultimately are based on the dollar. The dollar is often referred to as a vehicle currency, because all other currencies are priced with respect to the dollar. And many international contracts, such as oil, are priced in dollars. Okay, so in other words, if you call up Saudi Arabia and say, listen, my country wants to import oil, the price they'll quote you is actually dollars. They'll say, we want you to pay us X dollars for it. So the dollar is like the universal or vehicle currency. And, you know, it's funny, there's always a lot of speculation about, well, who's going to be next? You know, prior to World War I, the British pound was the world's vehicle currency. Most transactions were made with pounds. But that changed after World War I when the US economy started growing to become the world's dominant economy, as well as our military. And it's been like that ever since. But nobody's knocked us off our perch yet. So we'll see how long that lasts. But anyway, a futures contract, let's go back here. Let's see how it's different than a forward contract. Number one, as we know, forward contracts are negotiated directly between counterparties, which means they can be customized. A futures contract is bought on an exchange. Now, the drawback to that is that you can only choose what they have. In other words, if you look through here, let's say you're interested in a currency that's not listed here. Well, then you're out of luck. It's not there, okay? They don't have it. So what you, like the Chilean peso, for example, if I need Chilean pesos, well, they don't have them. So that means I would have to turn into the over-the-counter market and obtain a contract on Chilean pesos, a forward contract, most likely with a Latin American bank. Okay, they can write a contract like that for me. So now keep in mind, the forward futures exchanges make their money from volume. So they only offer the most heavily traded contracts. In other words, if a contract doesn't trade very often, then they'll just drop it. They need volume to make money. And if there's not enough business flowing back and forth between the US and Chile, then they may not be able to offer a Chilean peso US dollar contract. All right, so that's number one. Number two, as I mentioned before, with a forward contract, since it's just you negotiating with the counterparty, typically a bank, there's always a risk of default. So there's some credit risk there. Not so with the exchange. They'll guarantee that every one of these contracts will perform because they'll pay for it themselves if they have to. Interestingly enough, by the way, if I buy this Euro British Pound futures contract that I see here, what that means is that I'm entering into a contract to buy, let's see, let me pick one of the other ones. It'll be easier to explain it. Let's try the dollar and the pound. This one means if I enter into this contract, if I take a long position, what it means is I'm committing myself to using dollars to buy British pounds. Okay, in whatever time frame this is. But and so what that means, sorry, is that they behind the scenes, the exchange is matching me up with somebody else who wants to sell British pounds in exchange for dollars. In other words, if I enter into a forward contract, I'm meeting my counterparty directly. I'm saying to them, listen, I want to pay you dollars for British pounds. And they agree to it, and we have a contract. Here, I want to buy British pounds with dollars. They go out and they find somebody else who wants to do the opposite, and they match us up behind the scenes. So we don't know who's on the other side of this contract. It doesn't matter, because if they fail to make the payments that are required, the exchange will step in and make those payments for them. So they're basically saying that, yes, we'll match you up with a counterparty. You'll never meet. You won't know who they are. But if they fail to live up to their obligations, we will cover the cash flows that you are entitled to. So you basically then have no credit risk. Okay, none at all. Okay, the exchange itself would have to go out of business for you to lose money. Let's put it that way.
Could you explain the numbers quickly?
Which numbers?
On the website, yeah. So the British pound. What does the CBM2 means?
Oh, this is just a code used by them. This is their internal code. If you call them up and say, listen, I want to enter into a British pound futures contract, this is the code that they need.
Oh, okay.
Yeah, that. Oh, sorry.
Yes, go ahead.
That usually is like a indicator of what month, like what the actual contract month is, but it's like an identifier that they use for trading.
Right.
Information.
Right,
And
exactly.
The date, June 22nd, is the day that the contract expires.
That's right. That's right. This means that what I'm proposing to do is buy British pounds in June. Now, the exact date of the month depends on the exchange. It used to be a common practice that these contracts would expire on the third Wednesday in the month, but we can look on the website and find the exact details. It'll be in here somewhere. They have to tell you what the terms and conditions are for these contracts. In fact, if I click this thing on, it might take me right to that page. Oh, it's very slow, but let's see. What do they have to say for themselves? Here it is. Oh, well, oh, here it is. Here it is. So the contract is for 62,500 British pounds.
That's the minimum, you said, right?
Right. Yeah. And so in other words, I can't just ask them for 50,000 pounds. It's got to be 62,500 or nothing. And this is what I was saying before. These are not very flexible. They only offer certain contracts, and that's it. If that's not what you need, you really have to go to the forward market. Let's see what else. Okay, here it is. Full contract specs. So this is everything you could possibly need to know. All kinds of things like the limits on how far up and down can go during a given trading day. There are limits. Deliverable, yes. See, now this is an interesting detail. If you decide to take possession of the pounds, you will actually take physical delivery of the pounds. For some of these contracts, they're cash settled only when there's nothing to deliver. For example, if I buy a contract on the federal funds rate, that's a rate of interest. There's nothing to deliver. So when the contract is up, I will receive a payment equal to my profits. Or if I've lost money, I will send them a payment equal to my losses. Trading terminates at 9:16 a.m. Central Time, 2 business days. There it is, the third Wednesday, because that's when delivery takes place. So right up until 2 days before, you can continue trading these contracts. Also, here's another sticking point with the forward futures contracts. The delivery dates are only available in March, June, September, December. In other words, if you want to take delivery in August, again, you're out of luck. You have to take what they have. Let's see, what else can we find out here? Position limits. Oh my God. It's an entire spreadsheet. It must be very complicated. Wow. Well, at least, well, there it is. I guess the idea was to include everything. Oh yeah, look, there's Bitcoin. Anyway, so yeah, all the details are right here. So there's no problem there. And let's see, where were we? What they're also going to tell you is the price. Like right here, the last time it traded, the price, the futures price in this contract was 1.3111. That means I can lock in a price of $1.31.11 for each British pound that I want to buy or sell. Okay. And they'll show you what the price has been in the recent past and the trading volume. I guess that's all we can get out of this now.
Oh, so you can look at a price for June, any price you want?
No, it has to be the price, like right now, if I want to lock in a price, it's going to be 1.3111. I can't do anything about that.
And
Yeah.
what's the current price?
Of the British pound?
Yeah.
We can go look that up in Bloomberg.
Okay.
They're not likely to be the same. The futures price and the spot price will probably 13113 versus 13111. Okay, so they are slightly different.
Yeah.
And but this is the number that you're locking in right here.
And that's
Now, as we'll see, though, the way it's locked in is very different than the forward contract, because what's going to happen here is that you have to put up collateral with a futures contract. But oh, one more thing, I just want to mention this. What if you have entered into this contract, you've taken a long position to buy British pounds in June, and you change your mind? What if it turns out that you don't need them after all? Oh, hold on, there's a chat. Yeah, we're so close. That's a good point. The price is very close to the spot price because we're almost at the delivery date. Yeah, and so we're very close. And that, as you see in Hull's book, he's got a few graphs in there that show you that as we get closer to the maturity date, the spot and the futures price have to converge to each other. And, you know, like if for some of these other contracts, let's say we're looking at a September contract, the price difference could be quite a bit higher. But anyway.
So I'm sorry. So if I'm betting into a long position, I'm betting that the pound will go down, right?
Well, if what's happening here is that if you're hedging, you are locking in the price that you can buy it. Let's say you want to buy it.
That's a lower price at the current market, right?
Right. It means that I'm guaranteeing myself that when I buy to take delivery of my pounds in June, the price will be, the net cost to me of my pounds will be 1.3111. Okay, so I'm locking in, and the same thing if I'm selling, I'm locking in a price with my contract. But as I started to say, if I change my mind, I'm in a long position now, it's easy to unwind my position by taking a short position in the same contract, because this way they exactly offset each other. And that way I can say, oh, this is good. I didn't need the pounds after all. What do? It's easy to unwind your position by just taking the opposite contract. In this case, that would be a short position in the June futures, British pound futures contract. So this is something you don't get with the forward market. Forward market, once you're in, you're in. That's it. You've got a contract which says you must buy or sell this asset. Unless you can get the counterparty to agree with you and unwind your position, you're obligated to do what you said you would do. But here, it's not difficult to change your mind and get out of that position. In fact, that's one of the conscious decisions they've made to make it. One of the reasons why they have so few contracts is so that you have this kind of flexibility, that there'll be enough volume in all the contracts that you can actually offset everything that you do. And so that's one of the big advantages of futures contracts. In fact, and Holzberg mentions this, because it's so easy to get out of this position, usually what ends up happening is that investors who want to hedge their risk without actually buying or selling the asset are better off with a futures contract because it's so easy to unwind your position. Investors who really want to take possession of the asset or really mean to deliver it might be better off with a forward contract because they can't really get out of that. So if you really want the pounds, you really need to use them, you're probably going to want to hedge your position with a forward contract. But if you just want to hedge your price risk without actually taking delivery, a futures contract is more likely to be your best choice. So here's one, like an investor enters into a December gold futures contract on the CME to buy 100 ounces of gold. The investor changes his mind. All he has to do is enter into a short December gold futures contract on the CME to sell 100 ounces of gold. And so in other words, they exactly offset each other. They're still open contracts. It's just that whatever cash flows you get from one will exactly offset the ones from the other. So your net position is zero.
I'm sorry, can you repeat that a little bit slower?
Yes. So in other words, I decided to buy a futures contract to take delivery of 100 ounces of gold in December. And now for some reason, I've realized that I don't really need to do this. Let's say I've decided not to go ahead and buy the gold. I was going to use it to make jewelry or something, and now I've decided not to do that. What I can do is not cancel the contract, but what I can do is take the opposite position in the same contract, which means taking a short position in the exact same contract, which means that I've got an obligation to buy 100 ounces of gold in December and an obligation to sell it in December. So the two contracts exactly offset each other's cash flows. And so my position, my net position is exactly zero. I no longer have any exposure to gold. You know, it's like, this is the best analogy I can come up with, is like, imagine if you borrowed $100 from someone and then you lend that same person $100. Well, the bottom line is, even though you both have loans outstanding, the net position is zero, okay? Because the two cash flows exactly offset each other.
Can you, the previous slide?
Oh, yes.
What is this? A future contract may be offset by entering the position in the opposite future position.
Yes, that's exactly what I was just describing. In other words, if you have a long position in an asset, you can offset it by taking a short position in that same exact setup and vice versa.
So you can do that only in a futures contract, but not in
That's
a
right.
forward contract.
That's right. You can't do that with a forward contract. So once you have a forward contract, you're pretty much locked in. But if you have a futures contract, you're never locked in. You can always offset your position. And a lot of hedgers like that flexibility. And that's why they might choose a futures contract rather than a forward contract.
So when you are betting, like if you go back to the website.
Which one?
The website.
Oh, the website. Okay.
Yeah.
Yes.
So what's the belief of the other party, the people that are offering the British pound?
Well, they don't know anything about this. They know that you have a contract with them in which you've agreed to buy and they're going to sell. They don't know that you're taking an offsetting position because you're likely to be matched up with another counterparty. So as far as your counterparty in each individual contract, they don't know anything about this. But I, as the hedger, I know that my positions exactly offset each other so that I have no exposure to gold, or in this case, British pounds.
But so no, and just in the first, do they have their pounds, or they're just like offering?
Well,
them?
they have promised to deliver them. I don't know if they actually have the pounds, but if they don't, they're going to be in all kinds of legal trouble. They've agreed to sell me the pounds, so like I said, if they don't, the exchange will step in and they will take care of it. but then there'll be a legal problem for the other side of this contract who failed to deliver my pounds. Okay, so in other words, they've agreed to sell me the pounds. I don't know if they have them or not, but I don't care because I know that the exchange will find them for me if there's a problem.
So when will they make money if the pounds go lower or higher?
You mean the counterparty?
Yeah, when the counterparty.
Oh,
make
yeah,
money.
yeah. Well, they're selling them to me, so they hope to sell them to me when the price goes down.
Oh, okay. So they are hoping the pound is like 1.2
Yes, so they can
Okay.
sell me something at
at a
one.
higher price.
Well, because they're going to get the price that we agreed to is what they're going to get. So if the price is dropped, then they're happy because they're selling me an asset for $31.1, which might be worth less than that.
And in this option, this is an options account. So
No,
can
this is
make-
this is a futures contract.
This is a futures. How do I know it's a future contract?
Oh, it says it over here.
Oh, futures. And what does op means?
What is what? Oh, I don't know.
OPD.
Oh,
Oh,
I'm not sure what that means now that you mention it. Let's see.
okay.
It might be the corresponding option on that same. Oh, okay. You know what this is? We're going to see this later on anyway. It turns out that among the other things you can buy with an option are futures contracts. So in other words, this is a futures contract, but I can actually buy an option that gives me the right to enter into this futures contract, and it's called a futures option.
Mm.
So those are obviously even more complicated products, but most of these futures contracts do have options available on them. Maybe not every single one of them, but most of them do. And so that way, the option gives me the right to enter into the contract or change my mind. Okay, so we'll discuss that as well, but it's just, it's just an example of how the derivatives markets can get so complicated. And it's not the only one where you have options or derivatives written on other derivatives. And so a futures option is exactly that. It's an option which gives you the right to enter into a futures contract, which itself gives you the right to buy or sell the underlying asset. So it gets very complicated very quickly. So yes, that's why that's there in case you're interested in the corresponding option on that contract. So, and what's good about the option is that you don't ever have to actually enter into this futures contract if you change your mind. And you can see just since we've been talking, this thing's been changing. I wonder what time they close. I was under the impression that they closed at 6 o'clock in Chicago, but that can't be right because it's already 6 o'clock. But, well, I guess they trade all the time. Look at that. Some of these already, yeah, some of these must be already closed. But these are not. Huh, interesting. Anyway, so what that means then, now here's an interesting result. Because you don't ever have to take possession with a futures contract, you can offset your position. A lot of hedgers use futures contracts because they just want to hedge their position. They don't really want to buy the asset or they don't really want to sell it. And in fact, according to Hull's book, about 98% of futures contracts are offset before delivery takes place. In other words, it's a rare event. Whereas with forward contracts, it happens almost every time. You're actually saying, I want to buy this asset or I want to sell it. With the futures contracts, you may simply be interested in hedging your risk and taking your profits without actually buying the asset.
Yeah, but there is a chance that you might not find any other position to offset your contract, right? Like,
It's what?
Is there a chance that there is no position to offset your contract? Like,
No. See, that's the nice thing about this. The volume on each of these contracts is high enough that you should never have a problem doing that. That's what I was saying before, that this is one of the reasons why they're so standardized, to make sure that you should never be able to, you should never be locked out. I see what you mean. Like, in other words, imagine if this contract didn't exist, there's no more of them. No, it's not, it won't happen. They can guarantee that you won't have a problem getting your hands on the opposite position, because
Like
they'll,
for-
here's why, because they will take the opposite position themselves if they have to.
oh. But
Yeah.
for example, if we're going into war and we know like one currency is gonna devalue, right? Like who's gonna take a position that that currency is gonna,
Well, you know,
Increase.
because maybe we disagree with each other. We have different outlooks.
so you think there's always an opposite?
Yeah, I'm sure there is. I mean, and if, as long as the contract is on the exchange, they will either match you up with the counterparty, or else they will take the opposite position themselves, so that you don't have to worry about finding somebody who actually has the opposite outlook. But yeah, I mean, for any given position, chances are there's somebody out there who sees the opposite way. There's never going to be a time when we all are 100% in agreement on something like that, I don't think. But now, if you notice too that these have different volumes of trading, like this contract doesn't seem to be trading very often for whatever reason, but the Australian dollars are trading like crazy. But then these two didn't trade at all today, which is not that unusual. You know, these are not exactly huge volume currencies. You know, the US does some business with these countries, but not nearly to the extent that it does with Canada and Britain and Australia. So we had Swedish krona futures, Norwegian krona futures. But a lot of the other currencies, like, for example, there are some countries that don't have any futures at all because their currency just doesn't trade very often, like Iceland, for example. There's not going to be a futures contract on the Icelandic krona because it's such a small country. So they're hoping, they want to just keep this. They want to make sure there's a large volume for these contracts. So that's why there aren't that many to choose from, just the most popular ones. And again, like, if you can't find what you want here, you can either adjust your your hedging strategy, or you can just go to the forward market. All right, well, anyway, now the big difference between the two is the cash flows. With a futures contract, and they'll tell you in the terms and conditions, you have to put up collateral in a special account, which is called a margin account. Yeah, let me add this to my document here. With a futures contract, and this is the same if you're buying or selling. A futures contract, you must deposit a special type of collateral with the exchange known as margin. And what that does is it guarantees that your losses can't pile up, let's say. At the end of each trading day, the exchange recalculates the value of your position. And if you've lost enough money, you may have to deposit more money in your margin account. We'll go into this in more detail in a bit, into your margin account. If you can't, by the way, cover that, you do not make the appropriate deposit, your position will be closed out. That's it. That's the end of the story. You can see why they do this. They're basically trying to protect themselves. Remember, they're obligated to cover your losses with respect to your counterparty. And they can't let you just sit there and rack up huge losses day after day, because they're responsible for it up to a point. And so they're basically trying to say, listen, we don't want anyone to lose more than 1 day's worth, or suffer 1 day's worth of losses. Anything beyond that, they have to cover it with margin, and if they can't, then they're just closed out. So that's just for credit purposes to make sure that nobody loses so much money that they can't cover it and the exchange is on the hook for it. Now, this is often how, like with the Nicholas leasing case I was telling you about before, where he went out to Singapore to trade for bearings. This is what brought him down. He had a lot of futures positions that were losing a lot of money, and he kept having margin calls. And they were growing like crazy. So he would send documentation to London, which made it appear that clients were looking for financing, and these clients didn't really exist. But what he was really doing was he was raising the money he needed to make these margin payments. And eventually he just ran out of money. I mean, he couldn't do it. And then bearings couldn't cover them either because the amounts were so large. He was kind of a knucklehead. I mean, he, when he saw that his positions were losing money, and he was betting, he had futures positions on the Nikkei 225, the Japanese stock market index, and he was betting that the market index would go up. Instead, it was going down because of the earthquake. So after the earthquake, instead of unwinding his positions and taking his losses, what he did instead was he said, sooner or later, the Japanese stock market will bounce back. So why don't I do this? Instead of unwinding my positions, I will increase the number of positions I have. Oh boy. So in other words, he kept betting more and more that the market would bounce back. And of course it did not. And then he ended up losing all that money. It was just unbelievable that, it was bad enough. I mean, the trades weren't that good to start with, and he kept making it worse. He kept digging himself into a progressively deeper hole. But anyway, so this is what really brought him down. Otherwise, it's possible nobody would have ever figured out what was happening. But so here's a quick example of this. Let's say there's a CME futures contract on gold, and the initial margin is 5,500. Now, keep in mind, a contract on gold will probably have a minimum number of ounces of gold of 100. In fact, we could probably look it up. Gold futures. We can look at the terms and conditions, contract specs. It is for 100 troy ounces. In other words, when you enter into a contract on gold, you're actually committing yourself to either buying or selling not 1 ounce, but 100 ounces of gold. So let's say that one of these contracts has a margin requirement of $5,500. Considering, let me get my calculator out here, 100 ounces. Let's say the gold is selling for $1,500 an ounce. That's $150,000. And so the initial margin represents about 3 or 4% of that. So it's a very small amount. But the exchange feels that you probably won't lose more than that in a single trading day. It would require a catastrophically bad day to lose more than that. So that's how that gets set. It's roughly meant to be about 1 day's potential losses. The maintenance margin is 5,000. That means that the balance in your account can't fall below that. So we start by depositing 5,500. And now, because the contract is written on 100 ounces of gold, if the price goes up by $1, your margin position goes up by $100. If the price goes down by $1, the position in your margin account goes down by $100. It's 100 to 1. And so if the price drops by $10, the balance in your account drops by 1,000. So there goes your $1,000 and you're down to 4,500, but you've fallen below the maintenance level of 5,000. In fact, maybe we could draw a picture of this. You start out by needing, let's see, what would this look like?
Sorry, the initial margin is just money that you have in your account. You're not actually
Yes.
using it.
That's right. It's just collateral. It's still your money,
Yeah.
but you have to put it there just in case they need to use it to cover your losses. And so if the value, let's say you start here and then the price drops by $10 and you find yourself here at, let's say, 4,500, you have to bring it back not just to the maintenance margin, but you have to restore it to the initial margin.
I'm sorry. So you're putting money. How does the money can draw? Like,
How does
you
it
put
work?
if you put 5,500
Right,
in your initial margin,
right.
how does it go down? Is it liquid money
Oh,
or
no,
is it the
because
liquid assets?
no, the price of gold. Oh, you can use treasury bills if you want to. I don't think they'll accept anything else. It either is cash or treasuries.
Okay.
But the price, if the price falls by $1, $10, sorry, $10, the price of gold, that means your position falls by $1,000. That's why that happened. That's how it got down there. During the trading day, the price dropped by $10, and you know that the contract is written on $100. That means we actually lost 1,000. So that brought us down below the maintenance margin. And so now we have to top it off. In other words, they'll call us up and say, listen, you have to deposit another $1,000 in this account. Otherwise, we'll just close it out. So you do, and you put it in, and now you're back to 5,500. If, let's say now the next day, the price goes up by $10, okay? Then what would happen is you then can withdraw it if you want to. So if you choose to do so, you can withdraw it and bring yourself right back here. As long as if you're over the initial margin, you can take it back. But if you're under, you have to replace it. And so
Sorry, we were trying to buy 55.
no, the initial margin was 5,500.
So what how much we were buying with 5,500? What we were buying?
100 ounces of gold.
Oh, okay. So 100 ounces of gold. Okay.
So that means every time the price of gold changes by $1, our position actually changes by $100.
100 ounces of gold. And how much was the ounce?
Initially, let's say it was 1,500 an ounce.
Oh, okay.
So because the contract is written on 100 ounces, $1 change in the price, even if it just drops to $14.99, that means we just lost $1,000. Sorry, $100. Well, that won't put us below, but let's say it goes down to $14.90, which is what would have happened here. That's $1,000 that's lost. We have to replace it. So we put up another 1,000. But then the next day it goes up to 1510. Now all of a sudden we're up by $1,000, and we can take the extra out. And so in other words, you don't ever have to keep more than this, but you can never have less than the maintenance margin. So the reason why there's a gap here is so that every single price fluctuation doesn't cause you to have a margin call. And yes, by the way, when you are required to put in more money, it's known as a margin call. So, if there wasn't a maintenance margin, every time you fell below this initial by a penny, you'd have a margin call. It would be very annoying to everyone. So they give you a little bit of flexibility in there, but beyond a certain point, you've got to make you have to cover it. So anyway, this whole process has a special name. Hold on one second. This is known, let me just move these up here. As this process is called marking to market, meaning that every day your position is updated to match whatever's going on in the market. This is what this process is called, and this is what separates futures contracts. The biggest difference really is this. Futures contracts are marked to market. Forward contracts are not. There's no collateral with a forward contract. It's just an agreement. So you enter into the contract, and on the maturity date, you either buy or sell the asset, and you're all set. What is this? So that's one of the big differences. So with a futures contract, there can potentially be cash flows every day. With a forward contract, the only cash flows take place on the maturity date of the contract when the delivery happens. Okay, that's it, just one time only. Whereas with the futures contract, every single day there might be a margin call, or you might be able to withdraw your surplus margin. So it's, you know, it's a more complicated situation. But because of that, like I said before, there's no credit risk. With a forward contract, imagine in 6 months, it's time to take delivery of your pounds and the counterparty is going out of business. That can't happen with a futures contract. All right, so that's one of the more important differences between the two. And you can see it's kind of a nuisance, but like I said, it might be worthwhile to eliminate credit risk. But it does mean that if things are going badly for you, you can get wiped out. Your position could get wiped out because, again, if you don't cover the margin call, they will close out your position, and that's the end of it. Okay, so far those are the differences between futures and forwards. Now, swaps are a very different type of product. Let me just add this in here. A swap is essentially a portfolio of forward contracts that mature at different times in the future. Because with a swap, cash flows are exchanged typically every year or every 6 months based on a reference asset, such as an interest rate or a currency. Those are the two biggest, most common types of swaps, one written on interest rates and one written on currencies. There's many, many others, but those are the most common ones. And swaps are over-the-counter products because they do need to be customized typically. So it wouldn't make any sense to try to have one on an exchange because, you know, very few people need the exact same thing. So if you want to swap, you need to approach a derivatives dealer or a commercial bank, whatever, and they can set it up for you. And so why is this happening? A swap is a good way to hedge a recurring exposure. What do I mean by that? What if instead of needing to buy British pounds in 6 months, it turns out you need to buy British pounds every 6 months? This is a normal part of your business. So rather than having a bunch of different forward contracts, you can set it up in advance to have, let's say, 5 years of coverage. Every 6 months, we make a trade based on the strength of the dollar. So a swap is like a repeated series of forward contracts. All right. So now the underlying securities you can buy with swaps are essentially unlimited, but like I said, most of them are based on either interest rates or exchange rates. Oh, here we go. Oh, yes, I normally do. Oh, I didn't realize it was so late. I'm sorry. Yes, I think we could all use a bit of a break. So because it's such a long class, we typically have a break right about now. And I'm glad you reminded me. Let's knock it off for about 15 or 20 minutes. just long enough to get some refreshments. And then when we get back, we'll get more deeply into this. So, all right, very good. Let's do that. Let's come back at, let's say 7:45. Well, 7:55. Let's try 7:55. How about that? That should be plenty of time to have your coffee and send out a million emails, okay? All right, all right. So I'll see you in a few minutes. All right, here we go. Now we can look at swaps. And when that's done, we'll have a brief overview of options. And then, like I said, in the coming weeks, we'll be taking a much deeper look at each of these individual securities and especially delve into how they're priced, this is where the Excel spreadsheets will start to become very helpful because it's useful to organize the information in a way that we can see what's going on. So we start out with the swap. Now, as I started to say, the swap is more or less equivalent to having a series of forward contracts that expire at different points in the future, but it isn't, a single security. And so the most common underlying assets would be especially interest rates, exchange rates, but also sometimes you see equities, sometimes commodities and other financial variables. And, and I just want to mention just as an aside, although this course is not really about this, but in the 90s, we also saw the introduction of credit swaps, which were designed to provide cash flows, not in the event of changes in market variables, but in the event of defaults on bonds or other types of financial securities. So anyway, let's take a look at what an interest rate swap looks like. So an interest rate swap is one where we're trading cash flows based on two interest rates. One of them is fixed, which simply means it never changes. And the floating rate is the one that is reset every so often, let's say every 6 months or a year. And so this type of swap is helpful for us hedging the risk that interest rates will go up or down. And but in such a way that we have cash flows on a regular basis. Often it's every 6 months or 12 months, but sometimes it can be every 3 months. So here's a quick example. A bank owns a fixed rate bond and an insurance company owns a floating rate bond. Now, before we go any further, let me just take a step sideways and mention what does that mean to be a floating rate bond. So a fixed rate bond means that interest payments are set in advance. Okay, fine. A floating rate bond means that the interest payments are reset on a regular basis, such as every 6 months or every year. Okay, so in other words, that means that the interest payments will change over time. Now, you might want to compare this with, let's say, an adjustable rate mortgage, where instead of having a fixed mortgage rate throughout the entire life of the mortgage rate can change every year. Okay, so it's the same idea. It's a floating rate security in the sense that every year the new interest payment will be reset based on current market conditions. They aren't that common, but they do exist, floating rate bonds. They're actually helpful. An investor might buy a floating rate bond if he or she expects interest rates to rise in the future. You can see why, because it means that if interest rates do go up, the payments on your bond will also go up. But of course, if you're mistaken, the rates can go down and you'll actually end up losing money. So it's a very risky thing to do, but they do exist. And so what can happen here, though, with the swap is that you can trade one type of bond in effect for the other, because what you're basically doing is trading their cash flows. We'll see. Well, it'll make sense as soon as we have an example here. So suppose that the bank owns a fixed rate bond and an insurance company owns a floating rate bond. Now, of course, the owner of a floating rate bond is exposed to the risk that rates will fall in the future. That's the problem here. So imagine this insurance company is worried about rates going down. On the other hand, the bank might think the rates are going up and they would rather have the floating rate bond than the existing fixed rate bond that they own. So rather than sell these bonds, the bank and the insurance company instead can get together and they agree to trade the cash flows from the bonds directly to each other through the intermediary of a swap dealer. So imagine, for example, that each of these bonds is worth $1 million. The fixed interest rate is 5% per year. And the following schedule shows the floating rate over the next 5 years. So you can see in each of the 5 years, the bank's fixed rate bond is worth 5%. They're paying 5% of $1 million, which is $50,000. The insurance company's floating rate bond has rates that change every year. So in the first year, and let's see, oh, hold on one second. So just to make it clear, the bank owns the fixed rate company bond. And the insurance company owns the floating rate bond. They agree through the swap that the bank pays a fixed rate to the insurance company. The insurance company pays a floating rate to the bank. Okay. Now, because both bonds are worth $1 million, and the bank is paying fixed rates, every year the bank, in principle, should be giving $50,000 to the insurance company. But on the other hand, the insurance company owes money back to the bank based on the floating rate. So in the first year, the bank is supposed to pay 5% to the insurance company, and the insurance company is supposed to pay 3% back to the bank. So the net cash flow is that the bank pays 2% to the insurance company, 2% or $20,000. In year two, the bank's fixed rate is still 5% or $50,000, but now all of a sudden, the floating rate went up to 6%. So all of a sudden now it's the insurance company that owes 1% back to the bank, or $10,000. In the third year, both are exactly the same. There's no payment. In the fourth year, the floating rate drops to 4%. So now the bank owes 1% to the insurance company. And then finally, in the last year, the insurance company's floating rate went up to 7%. So on balance, the insurance company will pay 2% back to the bank. So what in effect is happening here is that all along, the insurance company has earned the 5% fixed rate, and the bank has earned the floating rate, which means they've traded the two, because previously the bank was collecting the fixed rate, the insurance company was collecting the floating rate. Now they've reversed the two. And that was by design. That's what they wanted. The bank is now earning the floating rate. The insurance company is earning the fixed rate. So they're both happy because the bank is optimistic that rates are going up, and they want to take advantage of that by collecting the floating rate payments. The insurance company is worried about rates, and so they lock in a 5% guaranteed rate of return by owning the fixed rate cash flows. And so, I mean, obviously there's
Sorry. When in that example did they swap the rates?
Oh, at the very beginning. Today, they enter into an agreement to make the trades of these cash flows, and they agree that this will last for 5 years.
And after 5 years?
So it's a 5-year contract. So it's a swap because they're trading cash flows from one bond to the next. So they're essentially trading each other their cash flows.
Well, who has the bond? The bank?
They each own a bond. Nobody changed, the bonds themselves haven't changed hands. The bank continues to own the fixed rate bond, and the insurance company continues to own the floating rate bond, but they've traded the cash flows with each other.
Huh? That's so strange.
So in effect, it's as if they traded the bonds. They didn't actually trade the bonds, but they might as well have, because they'll get the same cash flows as if they did. Now, of course, in practice, it would be very awkward to actually trade the bonds with each other, but this is very easy to set up. So this is an example of a swap, of a fixed for floating rate swap, where we're trading fixed interest rates for floating interest rates. And the purpose of this is that each side was unhappy with the bond they owned, and they're trading those cash flows for something that they prefer. It would be like, imagine if two landlords own houses and they traded the rents with each other or something like that. It's kind of the same thing. They don't sell the buildings, but they trade the rents with each other. Okay, it's kind of a weird analogy. No, there's got to be, no, there has to be a bond. The bond, it's the bond cash flows that are determining these payments. So you can't divorce this from the bonds.
So just to kind of, sorry, just really quick, just to unpack that question on the swap and the exchange of cash flows.
Right.
So sorry, just to really kind of dig into this one. So when you have, let's say you have the two counterparties you're referring to, and one prefers a fixed cash flow versus the other counterparty that prefers the variable cash flow for
Right.
whatever the reason may be.
Right.
One would enter into a swap. Let's say it's a swap that starts right away, just like you said, the cash flows exchange immediately.
Well, no, actually, no. Usually what happens is the first cash flow usually takes place one period in the future. Today, all they've done is entered into the agreement. And then next year or in the next 6 months, the first cash flow will start.
Okay. Yeah, I'm thinking of like, you have spot starting swaps sometimes and then forward starting swaps. So
well, you're right. You can adjust, but this is the standard plain vanilla version where they start in 1 year.
Got it. Okay, so you're saying in this type of scenario, the swap would be tied to some instrument. In this case, it's a bond. So there's like a bond that's two bonds. So one's a fixed rate bond and one's a floating rate, a variable rate bond.
Yes.
And because the swap or the contract is allowing for one party to receive the other party's cash flows.
Right.
Now, I guess the only part I'm confused is there a scenario where one party could receive a fixed cash flow where the other party receives a floating or a variable cash flow that isn't tied to a bond? Wouldn't it just be like a contract that says?
It's the floating rate that has to be tied to something. It doesn't have to be a bond, but there has to be some way of figuring out in advance how you would calculate the floating rate. The fixed rate is easy. You just say it's 6%.
Yeah, right.
The floating rate, there has to be, you might say, for example, every year we'll look at the Fed funds rate and we'll add 200 basis points to it, or something like that. That could be done too.
Oh, I see. Right. So like, this is just an example of like one scenario, right? Like, so yeah, it could be a benchmark, or the underlying reference point could be anything, but you're establishing a schedule based on one rate that's fixed versus one that is variable. I got it. Okay,
that's right. It could be literally anything. You could tie it to the prime rate. You could tie it to the mortgage rates. As long as there's some number out there that you can both agree on, that will change from time to time, then you can certainly do something like this.
Thank you.
Okay.
Oh, sorry. Like, for example, I work in real estate development. And so when we're building something, right? We have a loan.
Right.
And then we do a swap. I don't know exactly what we do, but then we're fixing the rate. So we swap our floating rate for a fixed rate.
Okay, to eliminate interest rate risk. So in other words, if you're uncomfortable paying a floating rate of interest, this is what you can do. You enter into a swap where you're going to receive fixed cash flows in exchange for your floating cash flows, or vice versa, depending on what you want to do. You're converting one stream into another stream, or you're trading them for each other. Right,
but that's a conversion, and it like ends because supposedly we at the end we'll pay the loan, right? So there's just the bank is agreeing to like giving us a fixed rate.
Right, and if they're not, if they insist you take a floating rate, you can then swap it into a fixed rate with another counterparty or with a swap dealer. Okay. So in principle, you can trade any set of cash flows or any other set of cash flows.
So when do we do a swap?
You would do a swap if you have a repeated series of exposures that you want to switch somehow, like fixed for floating, or in the case of the currencies, you may want to trade dollar cash flows for British pound cash flows and that kind of thing. That would be more common for companies that do business in two different, multiple countries. Like, I'm receiving all my revenues in Britain in pounds, but I want dollars. So I enter into a swap, which I agree to trade the pounds for a fixed number of dollars or something like that. Can be done with a currency swap because I'm earning revenues, which is fine, but they're in the wrong currency. So I trade them out for dollars at an exchange rate that's been determined in advance.
Even in your even in your insurance company example, some insurance companies have products that are tied to a fixed rate, and they may want to hedge their distribution of that product by swapping it with something that has a variable rate.
Yes.
Or vice versa.
Yes, absolutely. So as long as you have a series of repeated cash flows, whether it's fixed or floating or whatever it happens to be, if you want to switch it for something else, you may be in a contract that you can't get out of it, but you can still trade the cash flows for something that you prefer. It's kind of like, you've ever seen those ads on TV for, they have these companies now that will offer to give you money in exchange for an annuity or whatever it is. They're kind of doing the same thing. They're saying, listen, we know you're not going to get that money for a while. We'll give you X dollars today and you send us those cash flows in the future. It's kind of what they're doing. But anyway, this is a huge market. In the original swap, somewhere along the way, there was a situation around 1980 where IBM wanted to borrow money in one currency and the World Bank wanted to borrow money in another currency, but there were legal restrictions that prevented them from borrowing the currency they wanted. So what they did was they agreed with each other that they would borrow each other's currency and trade it between themselves. I don't remember all the exact details, but that was the very first ever swap. And once people saw what happened, they realized, hey, this is a good idea. And before you know it, Wall Street is offering all kinds of swap products to all their customers because it seemed like such a brilliant idea. And the market is massive, beyond massive. And I'm sure we could come up with a lot of other interesting examples. Like, imagine that you're a farmer and you're worried about crops, the prices of your crops going down. You could trade, oh my God, you could do all kinds of things. You could trade the future earnings on your wheat for a specific rate of interest. There's all kinds of possibilities. But anyway, so this is your standard plain vanilla interest rate swap. There's a fixed rate and there's a floating rate. What's interesting is that the floating rate for many, many decades used to be tied to LIBOR, which I don't think still exists. They may have phased it out already.
It's SOFR, tied to the MIS rate.
Okay. So now every country now has to come up with its own short rate to take the place of LIBOR because of a few crooks at Barclays Bank in London who couldn't keep their hands out of the cookie jar. They were basically manipulating the LIBOR market to their advantage. And so when it became obvious how easy this was to do, everyone had to scramble to find something else. So this is published by the Fed, and it stands for the cost of borrowing. Oh, if a bank, let's say, wants to borrow money, just for a short period of time, typically, and they decide that they will, rather than just borrow money, they will enter into a transaction where they say, listen, we will sell you a treasury bill and we'll buy it back tomorrow for a slightly higher price. That is referred to as a repo or repurchase agreement. And it's a risk-free loan, basically, because if they don't buy the treasury bill back, the other bank still has the treasury bill that they can sell. So the secured overnight financing rate, it doesn't specify exactly how they calculate it, but it refers to the cost of these overnight loans. So it's a very low risk, very liquid rate. And this is exactly what they needed so that now all floating rate contracts can be tied to SOFR or some function of it. let's say that you've got a bond with floating rate coupons. In the past, they would have been tied to LIBOR. Now they can be tied to SOFR. And I don't know if you noticed it when we were looking at the Chicago Mercantile Exchange, but they have derivatives written on SOFR. Of course they do. They have derivatives on everything. Yes, those are for other, I don't remember. I haven't, Ionia, let's see what country that is. That's for the euro. Okay. And then ESTR. Yes, that's exactly right. It's the same kind of rate. Okay. It used to be so much easier with LIBOR. You could say dollar LIBOR, yen LIBOR, pound LIBOR. It was so simple. Now they had to go and blow it for us. Not only that, but LIBOR was available for maturity rates out to 1 year, whereas the SOFR and all the rest are just essentially overnight rates. So if you're looking at tying a bonds payment to it, you have to make some adjustments because those payments are going to take place way into the future, and they're being tied to an overnight rate. But anyway, very interesting. And by the way, if you want to read up on stuff like that, the New York Fed, all the Feds really have all this wonderful information on their websites for free. It's meant to be used by people who are not necessarily specialists, but are able to read fairly complicated material and understand it. They do have all the stuff for free. Wonder when they started. March. Okay. Well, anyway, there it is. That's what it looks like. So, LIBOR, which, well, when I first wrote these notes, we were still using LIBOR, but, oh, I did mention it here. It will soon be replaced by SOFR because of scandals. Wow, scandals in the financial markets. Who would have thought? A repo is an agreement which low-cost collateralized loans are made between banks. Oh, so here's an example that I wrote. Bank A has a treasury bill in its portfolio worth $1 million. It needs to raise cash in a hurry without selling the T-bill. They approach Bank B. Bank B buys the bill for $1 million and agrees to sell it back for $1.5 billion. So in effect, Bank A has gotten a collateralized loan in exchange for a cost of $500. Let's see what percent that represents. Now, I just made these numbers up, by the way. That might be too high for all I know. That's like 1/20%. Yeah, that's not that high. Okay, good. So that's how it's done. So the SOFR refers to the rate, the implicit rate that's being charged here on an annual basis. All right, now here's one where we actually have a diagram, which I think will help visualize what's going on here. Suppose we have this following scenario. A corporation has issued $100 million worth of debt, corporate bonds, that is. It's a 5-year bond, LIBOR plus 2% coupon. And the problem now is that they're exposed to the risk that rates will go up in the next 5 years. If they go down, fine. But if they go up, the company's going to end up paying more interest. So what do they do about it? Well, they can't refuse to make these payments. So what they can do instead is enter into a swap. And what they're going to do is pay a fixed rate to a dealer, and the dealer will in turn provide them with a floating rate. Okay. So at the end of each year, the difference between the two is exchanged between the counterparties. So let's say they agree to enter into a swap with the dealer where they pay 6% in exchange for LIBOR for the next 5 years based on the notional principal of $100 million. All right, let's take a look at this. Now, the corporation is paying LIBOR plus 2% to the bondholders. They're also paying 6% to the dealer. the dealer brings them back LIBOR. So if you add up the cash flows that they're paying and that they're receiving, you'll see that the net cost to the corporation of this arrangement is to pay 8% total instead of what they were previously paying, which is LIBOR plus 2. Okay, so in other words, they've traded an exposure to a floating rate to an exposure to a fixed rate. So if LIBOR goes up, they'll feel very proud of themselves for saving some money, but if it goes down, they'll probably regret it. But the logic is that if they're really worried about rates rising, they've locked in a fixed rate of 8%, whereas previously they would have had to pay LIBOR plus 2 no matter how high LIBOR went. So the purpose of this was to eliminate their interest rate risk. All right, now here's another one where a pension fund owns a floating rate bond. Okay, so they have this bond in their portfolio and it will pay them floating rate coupons. The notional is $1 million. It matures in 2 years and they're receiving LIBOR plus 3. The problem is they're worried that rates will go down, which means their cash flows will be reduced in value. So why don't we do this? Let's offer to pay a floating rate to a dealer in exchange for a fixed rate. And so let's say they agree to pay LIBOR in exchange for 7%. What does this accomplish? Well, let's see. So they're collecting LIBOR plus 3 from this bond. They're passing along the LIBOR to the dealer. They receive 7% back. And so instead of getting LIBOR plus 3, they've locked in 10%, guaranteed regardless of the level of LIBOR.
Sorry, when you're doing the swap, you're only swapping the rate with somebody, but you're not swapping your contract, right? Your original contract.
Right. You're not trading the bond itself, and you're not trading the principal either. You're not trading the $1 million bond. You're just trading you're actually trading the net difference between the cash flows on the interest rates.
Okay. So
the cash flows themselves could be very small.
Yeah. So when we do our real estate loan swaps, it's irrelevant to the lender. It's just so we just traded the rate with somebody else, but the lender still gets the same money.
Right, you're collecting some money from the customer, and then you're trading it for a different kind of cash flow, based on what you think is like your risk profile. Like, are we willing to put up with floating rate revenues or not? That kind of thing.
I'm sorry, I didn't understand. Like, for example, I am the borrower, right? So a bank lends me money at a floating rate.
Right.
And so if I do a swap, I'm going to do a swap with a third party, but I'm still the borrower of the original lender.
Oh yeah, that hasn't changed. Your original underlying position never changes. That's one of the beauties of these.
So the lender is still receiving whatever
he
agreed, either the floating or
the
fixed rate.
That's right.
But there's a third party who will deal with the lender, right?
That's right.
In the rates. Yeah. Okay.
Exactly. Yes. The original transactions don't change. Just like this pension fund is still receiving LIBOR plus 3% from the bond from the corporation. It's just that now they're trading with the third party, as you said, so that the net effect is to convert LIBOR plus 3 into 10, guaranteed.
So basically the swap dealer is connecting you with a rate better.
Right. You're switching one stream of revenues into another that you might prefer.
And so who is on the other side of the swap dealer? Is someone who's betting on the rate, right?
Okay. Yeah. The dealer is probably also involved in a transaction where they're paying LIBOR and receiving fixed from that other counterparty. In fact, what will happen is the dealer will arrange a swap with somebody else that will offset these cash flows. And then what they'll probably do is they'll offer to pay, let's say, LIBOR to the other counterparty in exchange for 7.2%, let's say. And then the difference between what they're collecting from the other counterparty and this one is what goes into their pockets. So there's a bid-ask spread involved with swaps. I think I have an example of that here. Let me see if I can find it. No, it's not here. But so in other words, the dealer might agree that whoever comes along and wants to do a swap in exchange for LIBOR, the dealer will pay 7.2% or receive 8%, well, 7.6%. In other words, I can go to the dealer and pay them LIBOR and they'll pay me 7.2%, or I can offer the dealer 7.6% in exchange for LIBOR. That way, there's a spread of 0.4%, which they'll profit from. And so this way, you know, ideally they'll line up all their counterparties with each other so that there's no net exposure to interest rates. And then yet they're still collecting this 0.4% spread, which represents the difference between what they're paying and what they're receiving in exchange for LIBOR. So it's really no different than the currency dealers, the foreign exchange dealers. They pay a low price for currency and they receive a high price. It's just that here it's an interest rate. So, you know, in fact, you can imagine a situation where here's a counterparty. Here's the dealer. Let me fix this a little. Let's call this Bank A or something like that. And here's Bank B. So if Bank A is paying LIBOR to the dealer, they're getting back 7.2%. And then in this case, Bank B is paying 7.6% for LIBOR. So in other words, the spread is the difference between these two. And that represents the dealer's profit. So with Bank A, the dealer is receiving LIBOR. With Bank B, they're paying LIBOR. So this is what they're trying to do. They're trying to make sure all these cash flows offset each other and leave them with a profit. That's how they make their money. Okay. So with a currency swap, we typically exchange a fixed interest rate, but denominated in two different currencies. Right. In other words, I might trade 6% in pounds for 7% in dollars or something like that. With a currency swap, though, typically the motivation here is not just to trade the payments, but also to trade the original principal amounts, which means that you need to acquire the underlying currency. So here's a simple example. A U.S. corporation wants to invest in a 5-year, 100,000 pound bond with a 6% coupon rate issued by a UK corporation. Now, the corporation wants to avoid the risk that the dollar will get stronger, which reduces the dollar value of the pound payments. So let's see, what do they decide to do? Let me just jump ahead a little bit and show the graph. Here's a corporation. They buy this British pound bond. Actually, you know what, let me copy this to a new page so it's not so cluttered. Okay, so they decide to buy this British pound bond, which is paying them 6%. Now, by the way, let me mention here that the original principal for the UK bond is £100,000. And the dollar bond, it's 190,000. So they do actually trade the principals. So in other words, the corporation pays 190,000 to the dealer for £100,000. And then every year, this 5% payment that the dealer pays them is worth $9,500, because that's 5% of 190,000. The corporation now has to pay back to them 6% of 100,000, which is £6,000. And that will continue for however long this lasts. And then at the end, or on the maturity date, these cash flows are reversed. In other words, the 190,000 goes from the dealer back to the corporation, and the corporation returns the £100,000 to the dealer. So what effectively happens is that the US corporation has traded, in effect, a UK bond, which it owns, for a US bond, which it does not own. The cash flows that accrue to the US corporation are the same as if they bought the US bond in the first place. And the dealer is getting the cash flows from the UK bond. So it's a more complicated setup. But the point of it is that they can trade not just the rates, but the currencies. Now, in some cases,
sorry. So in that example, there was no really currencies involved. It was just, I'm sorry, there was no rates involved. It's just the currencies, and like you're hoping that the fluctuation of the currencies.
they're both a fixed rate. So it's more about the currencies here than the rates.
Okay.
Now, if this is done properly, it's actually possible with swaps. Happens sometimes is that a corporation, let's say an American corporation, finds that it's possible to borrow more cheaply in another country, but they don't want to bear the foreign exchange risk. So what they can sometimes do is they can borrow in the cheaper country and exchange the yen in this case for dollars, and then they can end up saving money by borrowing this way. So let me show you what that would look like. The US corporation borrows yen. Okay, 100 million yen. And that in the moment is worth, let's say, $10,000. So they're going to borrow the yen, they're going to trade them to the dealer for $10,000, and then these cash flows will be traded. 0.5% from the Japanese yen goes to the corporation, and 1% goes to the dealer in dollars. That way, the corporation can pay off its loan. And what ends up happening is that they're paying, in effect, the corporation is paying 1% in dollars. Sorry, 1% in dollars. Whereas if they, without the swap, if you recall, corporation pays 1.5% in dollars. So they save 0.5% by borrowing in yen and then swapping the proceeds with the swap dealer. Okay, they don't want the yen. They want dollars, really. So they borrow the yen because it's cheaper, and then they trade the yen for dollars through the swap. And so in this way, they can save some money.
Sorry, I don't understand how the corporation would have to pay 1.5% otherwise.
Oh, we assumed that in the beginning.
Oh, okay.
So this is why they went into this arrangement, because they knew that they could save money. They were assuming that their credit rating is such that it would require them 1.5% to borrow in the US. Now, if they could borrow 1% in the US in the first place, there'd be no point in doing any of this. It's because their costs in the US are higher. Maybe they have a bad reputation in the American markets. I don't know. But for whatever reason, they're able to save some money by borrowing in the foreign currency and simply trading the cash flows for American dollars. Anyway, with all that being said, we're ready to take a quick look at the most complex of all the derivative securities, which are called options. And so options, we're going to spend an awful lot of time with these throughout the course because they are so powerful and so flexible. They make our lives much easier when it comes time to developing hedging strategies, but also trading strategies. We're attempting to profit from our outlook on different market variables. Now, the drawback to options, though, is that if you look at these others, a forward contract is simply an agreement. You do not actually pay money to do this. A futures contract does require collateral in your margin account, but you still are not actually paying for this. It is a contract, it's an agreement. The swap is the same way. It is simply an agreement between counterparties. The option is the only one that you actually have to pay for. So that's what one of the other things that really separates it from the other derivatives. You have to pay for it. And the price of an option is something that eluded the greatest thinkers for many decades until the Black-Scholes model was published in 1973, which we'll see later on, which suddenly made it possible for traders to understand how much these options are really worth. And that's what really got the options market started. Now, an option is a derivative security that gives us the right, but never the obligation to buy or sell an asset in the future where the price is agreed on today. So it's basically the same thing as a forward contract if you could change your sorry, if you could change your mind. With a forward contract, you're obligated to do whatever it is you agreed to. But with an option, you can say, listen, I don't want to do this. And you can walk away from the whole thing. So that's what it really is like a forward contract, except that you have the right to change your mind. Okay. So what do we need to know to characterize an option? Number one, the underlying asset. This is the asset that can be bought or sold. And at this point in time, options are available on many, many different kinds of securities or financial assets or other macroeconomic variables like interest rates, currencies, equity indexes, precious metals. And as we mentioned earlier, futures contracts. You can actually buy an option on a futures contract, which is called a futures option. You can also buy an option on a swap. And if you do that, it's called a swaption. That's right. How clever of those Wall Street dealers to call it a swaption, an option to enter into a swap, which you can change your mind. By the way, futures options turned out to be extremely helpful. Let's say they have very popular features. It turns out most options that trade in the market at this point in time are actually futures options because they have a lot of convenient properties that options directly in the underlying assets simply don't have. There's also, you can buy an option on a forward contract too, and those are called forward options. And you can buy an option on another option. These are called compound options. It's unbelievable what you can do. Now, a strike or exercise price is the price at which you can buy or sell the underlying asset. The maturity is the time until the option matures, which typically is less than a year, although not always. And what this, the significance of this is that you've got to make a decision by that date whether or not to exercise your option. In other words, should you buy the asset or sell it or not? If you don't decide by that date, it just expires and it becomes worthless. Now, the two basic types of options are the call option, which is the one that gives you the right to buy the underlying security, and the put is the right to sell it. All right, so just remember those words. Call means you have the right to buy, put means you have the right to sell. I don't know the origin of those words, but that's what is used in the markets. And then it turns out that most options fall into one of these two categories. European options can only be exercised on the actual expiration date, and American options can be exercised any time until that date, which means the American options are more expensive than the European options, but they're more powerful and flexible. And, just like in any other discipline, you get what you pay for, right? In other words, to have more flexibility, you have to be prepared to pay a higher price. Now, in the majority of options are American style, but you do have certain ones that are European style. Usually, for example, interest rate options are European style, and equity options tend to be American style because that's what investors want. Okay, now the price you pay for an option is often called a premium. Okay, in fact, I'll tell you what, just for the fun of it, why don't we do this? Let me show you this website, which you may have seen, finance.yahoo.com, and we can take a look at some actual options on Apple stock. So keep in mind the price of the stock is about 178 today, right there. So what you're seeing here is the options that mature on April the 8th. And all of these are calls, and these are the different strike prices. So for example, this option means I can buy this stock for $100, which is pretty sweet because the stock is worth $78.44. So because of that, the option is very expensive. Look at that. You're paying $79.55 for this option. And as the strike price goes up, the benefit of having the option goes down. Like say, for example, what if you had the option with a strike price of $200? Now, this one is not very valuable because you're being asked to pay $200 for something that's worth $178.44. Now, I've never seen this before. These are negative. I don't think it's possible to have negative prices. That's what I'm seeing here. Usually it stops at a penny or it's got to be worth at least a penny. But anyway, the higher the strike price, the less valuable these calls will be. If you look at the puts, it's the other way around. For example, this one with a strike of 100, what is the value of being able to sell the stock for 100 when it's worth 178? The answer is nothing, basically nothing. But an option that gives you the right to sell Apple stock for $240 is going to be worth a ton of money because the stock is only worth $178.44, and that price is now about $64. Another thing I want to point out here is that if you look at the some of the other dates that are available to us, like let's say if we look at June 17th, it's going to update. Okay. The further we go out into the future, the more expensive the options become because there's more time before the expiration date, and that gives us more opportunities to make money. So the options will become more expensive as we move further into the future. All right, so with all that being said, the prices can be modeled by the Black-Scholes model or some other type of model. And we will discuss the Black-Scholes model in great detail one of these days. But just as an aside, the developers of this Black-Scholes model were ultimately awarded the Nobel Prize in Economics, which shows you how important this turned out to be. I mean, that's as important as it gets, the Nobel Prize. Oh, I didn't even realize it. This is the end of the chapter. Let's see what's coming up next week. Oh, intro. Let's see. I think this next week we're going to have more. Oh, we're just going to have more. We're going to delve more deeply into the pricing of these things. Today we had a broad overview, but I've increased the complexity of our examples. Oh boy. But you'll see why this is so important. So this is everything except options. We'll just be going back and revisiting these contracts and taking a more in-depth look at how they're priced. Okay, so that's where we're going next week. Now, in the meantime, there is an assignment this week, although it's very basic. You should have no trouble with it whatsoever. There's one question about forward contracts. Here you're being asked to explain 3 important differences between forward and futures contracts. And then finally here, there's a question about cash flows from a swap, an interest rate swap. So why don't you take a look at that, and then I will send you these slides for number 2, so you can read them in advance, and then we'll pick it up next week where we left off with chapter 2, or week 2, whatever you want to call it. Okay, session 2. I knew it was something. So, all right. So I guess that's about it for tonight. All right. So now we've got some background, and now we can build on that by taking a more in-depth look at these different securities. And oh, there's more details. Don't you worry. We're going to look at more specific examples, and we're going to delve into the relationships between them and understand how their values are determined in the market. All right. So if there's no last minute questions, I guess we're all plenty tired by now.
Can I ask one question, Professor?
Oh, okay. Go ahead.
Just wondering regarding future-based ETFs, what kind of structure are they? Like commodity ETF, for example?
You know what? I didn't see any listed there. We should investigate that because that's a very interesting area. Let me see if I can find quotes for ETF futures. Here it is. They start the trading. Let's see what year this is. Oh, they've had them for a while now. Oh boy. Let's see. What else do they have?
Wouldn't they mostly trade like index futures?
You would think that, yeah, whatever they're going
If there's
to pick,
ETF.
whatever has the highest volume, that's what they're going to go for. I can't believe it's proving to be so difficult to find. This is no, what's going on here? Let's go back to the actual CME. Maybe we can find it from there. See, what they're saying here is that there are index futures already. There always were. You could buy a futures contract, for example, in the Dow Jones, but because an ETF is designed to replicate an index like the Dow Jones, let's say, they also have a futures contract not directly on the NASDAQ, but on the ETF that is meant to replicate the NASDAQ. So it is a kind of a strange thing. I mean, I guess they have them both. They're trying to help us understand here what would be the good and bad things about these two products.
Yeah, aren't those like e-minis? Like they're
Yes,
not necessarily the indices, but they're
not gigantic. Like, oh, that might be what the big difference is. The size.
yeah, they're not necessarily the full index. And yeah, I mean,
yeah, it says here that the ETFs are not as liquid. These are not traded 24 hours a day. Oh, it says here some ETFs can have major tracking errors. So there might be discrepancies between the price of the ETF and the actual NASDAQ. So if you're trying to hedge the NASDAQ, that might not be your best bet.
like, I don't think there's, I don't think there's, I mean, maybe there is, but I don't think there's futures on like the actual ETFs. There's definitely futures on the indices, but I think the ETFs track the futures for people that don't have direct exposure to the futures contracts. They'd rather have it like in a ETF framework versus buying the futures contracts.
Yeah, it's very confusing the way they've written this. It's not, I mean, just by glancing at it.
For example, like a future ETF for corn, is it
Right.
like a series of different future contracts that keep being updated?
Probably found an ETF that trades on corn, and then the futures contract would give you the right to buy X dollars worth of those ETFs in the future. So you're locking the price of the ETF itself, as opposed to the futures on the corn itself.
Okay.
So you can see how there could be differences. They should, in principle, be the same, but apparently not.
Plus, the ETFs are structured more like mutual funds, so
Yes.
they have an actual NAV that's calculated
Yeah.
on the value of it versus a futures contract that
Right, as opposed to
different.
futures, yeah. So well, there must be enough differences between them that they're offering them both. But it doesn't say anything about the size of the contracts, though. This one is a mini. It does say the word mini up here somewhere, which just means it's a smaller amount. I'm sure we could look up the terms and conditions if we wanted to, but it's an interesting idea, though. But they probably don't have a whole lot of them. There's so many ETFs. I guess they're just focused on the stock index ones, like the NASDAQ and the Dow. I mean, it's a futures exchange. They can only have so many different products.
Right.
They have to make sure that they only pick the ones that have huge volume. So I can see why they would stick with the S&P 500 or the NASDAQ or the Dow. And then the others, you just have to buy the ETFs yourself, I guess.
Okay, thank you.
All right, anything else? All right, good. So I guess wish you all a good night, everyone. And I'll see you next week.
Thank you,
Okay,
Professor.
bye.
Have a good
Thank
night.
you.
Thank you.
Right.
Thank you.
Thank you. Have a good night.
All right, good night.
Oh, I'm sorry, can you put back the notes? You still have them?
Yes.
I kind of got stuck in the end of the previous page.
Mm-hmm.
No, the slides, like the notes you were writing in Word.
Oh, those notes. Yes. I think that's as far as I got.
No, a little higher.
Oh, okay.
Where you start explaining the definition of futures. Oh, of swap, I'm sorry, swaps.
Yeah.
You said a swap is essentially a portfolio. Where is it? That's another lower maybe, right?
Oh, it must have been up here.
Oh,
somewhere.
here, a substantial portfolio of forward
Okay,
contracts
good.
that mature at different times in the future. Okay. Gosh. Okay.
Let me know if you're ready to scroll.
1 second. What does what does it mean the swaps are over the counter?
Oh, they don't trade on exchanges. They're traded directly between counterparties or dealers.
Oh, okay. And what is this? It's a good way to
Oh, if
hedge
you're,
over.
yeah, in other words, instead of hedging a single exposure to, let's say you need to buy British pounds, not just once, but every 6 months, then
Uh-huh.
you might use a swap instead of a forward contract.
What does the hedge means?
Oh, to reduce the risk of your position.
Oh, okay. Okay. I'm not sure if I understood. It just seems like it's really fast. I'm not sure if I understood well, as we were doing the transactions, what was the benefit on one party, to the other party?
Oh, it's because they think that they know what's going to happen to interest rates in the future, and they want to change their exposure so that they can benefit from that.
No, I understand that. I just, when we were doing the examples, like I don't know, I just, in the individual examples, I wasn't sure, like,
Oh,
what does the seller wants? Does he wants the interest to go up or
oh,
down?
yeah. Like, for example, this one.
I think I had to think, to figure it
Right.
out, but it was just so fast that I couldn't.
Oh, all right. Well, you have the slides. We can go over this again next week if you want.
Okay, that'd be great. Okay.
Yeah, just remind me.
It's just like, these are all new concepts.
I know, because we
for
only
me.
have a few hours. Yeah, it's a lot of material to do in such a short time. So,
Yeah.
yeah, here are the slides. So, you have the slides, and then,
Okay.
we'll go over it again. Just write down a list of questions.
Okay. You're gonna email this, right?
Yes.
Okay, great. Okay. Thank you so much.
All right. Okay. Good
All right,
night.
have a good night.
All
Bye.
right. Bye.